Welcome to today's Explainer. Let's be real. If you're watching this, you already know that 2023 was an absolute roller coaster for the markets. The S&P 500 shot up, major tech names surged. Some companies literally tripled in value from the start of the year. And honestly, it was incredibly tempting to catch shiny object syndrome and just start chasing those individual stock run-ups. But today, we're shifting entirely away from that reactive stock chasing mentality. Instead, we are building a proactive, totally data-backed playbook for 2024. We're going to look strictly at the numbers to set ourselves up for long-term endurance, no matter what the market throws our way. Okay, so here's the game plan. To structure our 2024 strategy, we're using 5 foundational pillars. First up, macro factors like rates and elections. Second, maximizing your retirement accounts. Third, building an asset allocation for pure endurance. Fourth, holding cash for preparedness. And finally, why a small pinch of crypto actually makes sense. All right, diving right into pillar number 1, macro factors, rates, and elections. Before we even think about tinkering with our own portfolios, we have to check the macroeconomic weather for 2024. And the defining features right now are elevated interest rates and the upcoming U.S. presidential election. These two things dictate global capital flows, so we absolutely cannot ignore them. To really wrap our heads around how interest rates affect the market, there's this fantastic Warren Buffett quote. He famously said that interest rates are like gravity. If you theoretically pushed rates up to 15%, as he uses in his extreme example, suddenly safe government bonds look incredibly attractive. When bonds yield high returns with zero risk, massive institutional investors and pension funds take their money right out of the stock market and just pour it into those bonds.
Think about stock market valuations kind of like Goku from Dragon Ball Z training on different planets. When interest rates are low, it's like training on a planet with very low gravity. Valuations are completely unburdened, so they can jump significantly higher. But when the Fed keeps interest rates elevated, which they're projected to do for a while, it's like Goku training under intense, heavy gravity. That high gravity literally pulls down stock valuations. It makes it so much harder for them to surge. Then we have the second major macro factor, the 2024 presidential election. Now, elections always bring a ton of noise and anxiety, but as data-backed investors, we only care about the historical facts. And the data since 1933 shows that presidential election years are actually quite solid for the stock market. Historically, the year prior to an election averages a massive 16.3% gain, and the election year itself averages a very respectable 6.7% gain. The only major exception recently was 2008, and that was driven by a historic global financial crisis, not the election itself. So the big takeaway here, do not let political headlines shake you out of your investments.
Okay, moving right along to section 2, maximizing your retirement accounts. Now that we understand the heavy macro gravity we're operating in, let's zoom in. It's time to shift from the macro environment to the micro and focus on the exact tactical moves we can make with our tax-advantaged accounts in 2024. This year actually hands us an immediate, tangible opportunity. The IRS officially bumped up the contribution limits for major retirement accounts for anyone under 50. The limit for IRAs went up from $6,500 in 2023 to $7,000 in 2024. And the 401k limit increased from $22,500 to $23,000. That means we literally have an extra $500 of tax-advantaged space to play with this year. Now, $500 might not sound like a game changer. It's, $41 a month? But what happens when you actually use that bump? If you consistently invest that extra $500 a year into an IRA over the next 40 years, it equates to an additional $140,000 for your retirement. Just let that sink in. That is the staggering power of compound interest, and it's exactly why maxing out these accounts should be one of your top priorities. Let's transition to our third pillar, asset allocation for endurance. This right here represents the core philosophy of our 2024 playbook. We're entirely moving away from being enamored by 2 or 3 dozen individual stock picks. Instead, we're heavily focusing our asset allocation on broad market index funds, like the S&P 500, to build a portfolio that's designed to go the distance. I absolutely love this quote from Morgan Housel, the author of The Psychology of Money. He says, "Successful investing is when you lose the password to your investment account." Think about it. If you're constantly logging in, tweaking your allocations, selling, chasing the latest hot tech stock, you are reacting, not investing. Setting a diversified mix, forgetting the password, and just ignoring shiny object syndrome is the actual secret to long-term wealth building. And that brings us to the most important word in this entire explainer: endurance. Endurance is simply earning average returns for an above-average period of time. It doesn't mean beating the market. It doesn't mean finding the next Amazon before anyone else does. If you can just earn average market returns, but do it consistently over decades without interrupting the compounding process, you will literally place yourself in the elite top 5% of all investors globally. No joke. You can see exactly how this plays out when you look at the historical data. The fantastic financial blog of Dollars and Data analyzed market returns over rolling time horizons. When you look at a 5 or 10-year period, sure, there's still scenarios where the market goes down and you might lose money. But as your time horizon stretches to 15 and especially 20 years, those negative return scenarios virtually disappear. The longer you leave your money alone to work in broad index funds, the closer your chance of losing money drops to zero. That is endurance in action.
So, we're buying index funds and leaving them alone. But what about the rest of our capital? We're now shifting to Section 4, holding cash for preparedness. Now, this might be the most counterintuitive part of the playbook for a lot of folks, intentionally keeping a massive stockpile of cash on the sidelines.
You always hear traditional financial advisors say cash is trash because of inflation, right? They tell you to be 100% invested at all times. But our data-backed strategy for this year involves a slightly different split, roughly 70% in invested assets, like our index funds, and keeping around 25 to 30% in pure uninvested cash. So why on earth would we do that? Well, risk analyst Nassim Taleb really hits the nail on the head here. Invest in preparation, not in prediction. The greatest risks to our financial system are the ones nobody's talking about right now because they are fundamentally unpredictable. You literally cannot predict the future, so you have to substitute prediction with absolute preparation. Let me just pose this directly to you. Seriously, if inflation eats away at cash, why would you intentionally hold a quarter of your total net worth in it? It's a huge buffer, yes, but it actually serves a highly aggressive purpose when the timing is right. The crucial point is this. Roughly once every decade, the economy experiences a completely unpredictable black swan event. Think of the 2008 real estate collapse, 9/11, or the lightning-fast COVID flash crash. If you are 100% invested when those terrifying market crashes happen, you just have to sit there and watch your portfolio bleed. But if you have 25% cash liquidity sitting on the sidelines, you instantly transform from a victim of the crash into the buyer of the century. You can scoop up incredible, fundamentally strong assets at 50% to 70% discounts right when everyone else is panicking. All right, we've covered macro weather, retirement, index endurance, and cash preparedness. Now let's look at Section 5, a small pinch of crypto. This is by far our smallest allocation pillar, and we have to acknowledge right out of the gate that there's no true decades-long evidence-based strategy here, simply because the tech is too new. But it does serve a very specific tactical purpose. The absolute golden rule here is size. We are keeping our cryptocurrency exposure extremely small, a maximum of 5 to 8% of the total portfolio. With this tiny percentage, the game plan is to simply dollar cost average into the most established major coins out there, primarily Bitcoin and Ethereum. We are absolutely not gambling on speculative, unknown coins. So why dedicate even a small pinch to crypto in 2024? Two distinct catalysts. First, Bitcoin is increasingly viewed by some as a digital gold, a safe haven asset that acts as a hedge against unpredictable geopolitical turmoil. Second, 2024 brings the Bitcoin halving. This is an event coded into the software where the block rewards given to miners are literally cut in half, slowing new supply. Whether you believe the actual mathematical impact or not, the psychological FOMO on the market is massive. Historically, these halvings trigger a flurry of buying activity. So, the small allocation just positions us to capture some of that potential upside without risking our core wealth. As we wrap up this explainer, I want to leave you with one critical question to ask yourself when you check your accounts today. Are you constantly trying to predict the market's next move, or are you building a portfolio truly designed for endurance? Are you chasing quick wins, or are you positioning yourself to survive the crashes, buy the discounts, and thrive effortlessly over the next 20 years? Take the data, apply it to your own strategy, and let's make 2024 a year of incredible, enduring growth.